Hi, this is Azad Ahmed with Daisia Consulting, and we are now going to review Chapter 7 in the IFIC exam course. IFIC is Investment Funds in Canada, and if you want to become a financial advisor or a mutual fund rep or a personal banking officer in a bank in Canada, you must have the license for advising clients about mutual funds. And although you are only licensed for mutual funds and some deposits, GICs, you still need to know about all the investment types in Canada because somebody may come to your office with a statement with stocks or bonds or other items, and you need to know what they are so you can advise them properly. So, in this chapter, we are going to cover the various types of investments which are in Canada. So first of all, before we understand that, you really do need to know percentages because without percentages, you cannot really do any calculations in this course. So please keep in mind this may be grade 3 or 4 calculations, but some people still need a reminder. If you think about you want a part of a whole pizza. If you want half, that is 1 by 2. If you do that on your calculator, 1 divided by 2, you'll end up with 0.5. That is what the decimal is on the calculator. So 0.5 actually means 1 half. And so you can say I want 0.5 of a pizza. It's the same thing. Or you can say I want 50%. That's also half. So zero point 0.5, you multiply it by 100 to get 50%. So please keep in mind percentages, decimal, and fractions mean the same thing. 1/4 is a quarter. What is a quarter? So 1 divided by 4 on your calculator will give you 0.25. 0.25 multiplied by 100 is 25%. So a quarter is 25%. 1/5, 1 divided by 5 is 0.2, that's 20%. 1/10 is 0.1, and that is 10%. 1/20th is 0.05, and that is 5%. So please keep that in mind when we're doing calculations. And if you need to calculate what is 50% of 5,000, how do you do that? On your calculator, you need to understand that. So you multiply the amount by the percentage. And so the percentage is 50. On your calculator, you cannot do 50, there's no percentage. Well, you can press the percent sign, but still 50%, if you look at this, this is a 100, 100. So 50 divided by 100. When you do 50 divided by 100, that will give you your, actually 50 divided by 100 will give you 0.5. So on your calculator, you'll have 0.5. And then 0.5 times 1,000 multiplied by 1,000. Now your answer will be 2,500. Same thing, what is 10% of 7,500? So 10 divided by 100, that's 0.1 times 7,500 is 750. One other thing you can do is just move one decimal over. 5%, 5 divided by 100 times 9,000 is 450. So if I invest $9,000, I get 5% return in the bank. Then every year I will be getting $450. That is my return. If I'm getting 2% and I invest $6,000, how much will I get annually in 1 year? I will get 2%, that is 2 divided by 100, that is 0.2, and divided by, I'm sorry, multiplied by 6,000, and you will get 120. So you'll get $120 annually from this investment. So please make sure you understand how to do these percentages, how to calculate this, because we will be doing some calculations also later on. So those are basic understanding that you must have. So why do companies issue fixed income products? We have a company, they have a building, and their overall company is doing pretty good. Now, they don't have enough space. They need to buy another building, or they need to buy another factory, or they need money for this purpose. So, what can they do? So, in order to finance their growth, a company or even the government of Canada, they can raise capital, they can raise money in several ways. So let's suppose they want to buy another company, they need $5 million. So one is to use leverage. Taking advantage of leverage means to use other people's money and invest it to earn income. One option is they can go to a bank, get a bank loan. So they can go to the banks and say, I need $5 million. Okay, they'll say, all right, give us all your statements, your information, they will look at a lot of things. They need to give them a lot of documentation. And then the bank decides yes, no, or we can give you only less. So that's one thing they can do. Other thing is they can issue a bond. So we'll talk about the bond. It is a investment where people can invest in that bond and the company can use that money in their business. So these both are using leverage because they have to pay some interest on the bank loan. They have to pay some interest on the bond also. So issuing a bond is similar to getting a bank loan for the company. So we'll talk about that in more detail. Later on, we'll talk about stocks or shares. So they can also issue stocks or shares in the market, but there are certain requirements for that. And that way also they can raise capital. Another option is if they have their own money, they have their own savings, they can use their own retained earnings. If they have $5 million lying around in their accounts somewhere in savings, they could use that, right? So, but not all companies have that. They can also apply for government grants. They can apply and they may get a portion or a part of this as a government grant. And so this is also possible. So, but it depends on the company, what they want to do and what they can do to achieve those objectives. And so, in this way, they would be undertaking their activities accordingly. In order to raise the funds, they may use a combination of these also, or maybe two or three, depending on the situation. So, we are now first focusing on fixed income securities. We're looking at bond types mainly in the first section of this course. And so the common characteristics with most fixed income securities is there's a payment of a regular income stream. That is the aspect. As an investor, if you are investing, if you're buying a bond, you will get a regular income stream. Think of it as a mortgage payment, right? So um, how much you will get and what is the situation of it, there will be a document called the trust deed, and that has the details of the bond in it. So the trust deed is your document that will explain all this information. So what is a bond? It is basically the company has a security such as a building or equipment, and they agree that this will be sold if the company defaults on the payment or they don't return the principal. They will say that, okay, if the company goes bankrupt, don't worry, we will return your money, we'll sell this building or we will sell this machinery and we'll give you back your money. So they give security by pledging something. It's just like a secured loan, right? So in this way, they are providing that to the investor. Another type of bond is called a debenture. Debenture is a bond that has no security. So there's no such thing as a building or equipment. So usually large companies, established companies, or government, they will issue the debentures. So different types of bonds. There are government bonds, which we will talk about in more detail, which are marketable. There are marketable bonds, which are Canada provincial bonds. So the government of Canada issues the bonds. There are Canada saving bonds, provincial bonds, and there are installment debentures, which are used by municipalities. So you can buy a bond by a city, issued by a city. You can buy a bond from the Ontario government, BC government, and then from the federal government. Now, Canada saving bonds have been discontinued, but those also were issued and they have now expired. So these are different types of bonds. The government also issues bonds. The installment debenture is just saying that, okay, you will get some portion of your investment back every year. So those are municipal bonds. So how does the bond work? We mentioned what it is, but let's see. An investor has $10,000 to invest. They take their money and they will go to the bank or to the government and they'll say, here, you can use my $10,000 in your business, but I need a regular income from it. I need some money back every year from it because I'm giving you my money to use. So the payment they can get is based on the coupon rate. What is coupon rate? Coupon rate is basically a technical name just for the interest rate on the bond. Let's assume the coupon rate is 3.5%. So remember, I just explained to you how to do the percentages. You need to know how to do the calculation. 3.5 divided by 100 times 10,000 is $350. So they will get $350 every year. So year one, they get 350. Year two, 350. Year three, year four, and the last year also they will get $350. So that is their, you can say, think of it as a payment, a regular payment that they're getting. So the bond trust deed, as we said, is a document. It will tell how long is your money locked in for, and what is the coupon payment, the annual interest. Does the company have some item pledged or security? Can the company cancel the bond before maturity, etc.? All this will be in the document there. So this bond, let's suppose it has 5 years maturity. So for 5 years, the company gets to use that money in its business. The government gets to use that money. It's not just one 10,000. There may be a million people have bought it. So they now have $10 million. So this will overall help them a lot. And this way they can increase their overall, you know, money that they have available. And through this money, they can use this money in their business. And this way, on maturity, after 5 years, the par value or the principal amount is returned to the investor back. So after 5 years, the investor will get back their full amount. They will get back $10,000, and of course, they'll get the last $350 payment also on the last at the end. So what do we mean? This is called, technically it's called par value. Par means equal value. Face amount also it's called. Face amount is 10,000. Principal is 10,000. So these three words mean the same thing. If you see par value, face amount, principal, it means the original invested amount. So 100 par means 100% of the value is going to be returned to the investor. So next we talk about interest on the bond. So we already mentioned the coupon is the interest income. That is also another name for it. It's also known as the bond income, the coupon income, the income in 1 year. So in 1 year, how much are you getting? Now, this we mentioned previously, the regular bond has a fixed rate. For example, fixed rate is 3.5%. So 3.5% annually, they will get that. It is paid regularly. Usually most bonds, they pay every 6 months. So January 1st and then June 30th, they'll be paying out, or maybe other dates every 6 months. And this is called a semi-annual bond. The semi-annual bond pays regular income throughout the duration of the bond. It could be floating rate, just like a variable mortgage. It could be a variable payment that is a floating rate. And the floating rate depends on the market interest rates. The government of Canada changes the interest rates. And so this way, the payment may be increasing or decreasing over time. And that means your payments are going to be varying also. The step-up rate is possible also. That means in year one, they have 2%. In year two, they have 2.5%. In year three, they get 3.5%. So that is another way that interest payment may be paid, possibly. So the step-up rate provides that option also. And then there's zero coupon bonds. Those zero coupon bonds mean that the investor gets no interest during the duration of the bond. These bonds, zero coupon, strip bonds, also known as residual, they are usually short term. So we'll talk about these in more details. The T-bills are an example. The money is you're paid on maturity, an extra amount. So there's no payment before the maturity date. And then they're index linked. Your payment may be linked with how the stock market is doing. If the stock market is increasing, you get increased payments. If it's doing less, you get less payment. So the interest on the bond can vary or can be fixed. But the main thing here is that your principal is guaranteed on maturity. So you are guaranteed to get back a certain amount, the investment that you did, back on maturity. Okay, other bond features. So you can buy bonds from bond dealers for usually in denomination of $1,000, 1,000, 2,000, 5,000, 10,000. So those are the bond denominations. The bond pricing, par, as we already mentioned, means 100%. It's also possible you buy a bond which is in between, which is not issued from day one. It could be a 5-year bond and 2 years have passed, 3 years are left on it, and then you buy it. So when you buy it, you may buy it on a premium. Premium means at a higher price, maybe 105. You also may buy it at a lower price, which is 96. So when they say 105, it means 105%. So if it's a $10,000 bond, times 105%, again, 105 divided by 100 times 10,000 will give you 10,500. So you may be getting, you may need to pay more. That is a premium, 10,500. Discount is you may buy the bond cheaper in the market. So 96% means 96 divided by 100 times 10,000. So that is 9,600. So that is a discount. And so the bond pricing is varies. Now, why it varies, we'll talk about that later. How do you calculate? How much is the price? How much is the interest I'm going to get? That we will discuss later on. But keep that in mind that it may be higher, it may be lower. What is the bond yield? We'll discuss about the calculations. What is the current yield? That is how much return in 1 year. Most people, they just want to know for 1 year how much is the return, and they want to compare it with a, for example, stock or savings account or other, which should I invest in it or not? So that is the bond yield. Yield means how much you're giving. Current yield is within 1 year. Yield to maturity is if I hold this bond to maturity, that is till the end, that is to its actual maturity, then I will, how much return will I get? So it could be a 5-year bond, 6-year bond, 10-year bond. What is my return going to be? And that yield to maturity may be different because I may have bought the bond at a higher price or at a lower price. Term to maturity, usually money markets are up to 1 year, short-term bonds are up to 5 years, medium ones are 5 to 10 years, and long-term bonds are 10 years or more. So this is the general term to maturity concept. Then liquidity means, can I sell it with less chance of loss of value? So that is my liquidity. Negotiable is good delivery form. Negotiable means that you are undertaking it in, it is available, and marketable bond means you can readily sell it also. So as we said, there are different types of bonds. We're more talking about the government bonds right now. Federal bonds are non-callable. Non-callable means that the government cannot cancel them before maturity. So that is federal, non-callable. Marketable bonds, we have crown corporations, for example, Farm Credit Corporation. They are marketable, meaning they can be sold in the market for a fair price at any time. T-bills, we mentioned that these are issued by the government, by the federal government. So the federal government issues these. They are usually short-term. So you put your money in for 3 months, 6 months, 9 months, and then you get the money back, and with some interest also. Canadian bonds discontinued November 2017, so don't worry about them. Real return bonds, they are adjusted for inflation. If you have $1,000 and there's 1.5% inflation, so 1,015 will be used for the interest payment. Provincial bonds, they are guaranteed bonds. They are issued by provincial corporations. Example, every also province has, for example, Ontario's Ontario saving bonds, there's BC saving bonds, Quebec saving bonds. They can be variable, they can be fixed rate or step up. And then there are municipal bonds. So the T-bills, as we said, are sold at a discount and they mature at par. So you have a T-bill, for example, you invest $950. It's for 3 months. So after 3 months, you will get $1,000. So that is that is how you will receive the $1,000 at the maturity. So short term is 3 months, 6 months, 1 year. Difference between purchase price and par is the return on the investment. So in this case, the income is taxed as interest. So you do need to pay taxes on the growth. And so this is also possible. Okay, so we will continue in the next section.